Today we're going to look at how to forecast invoice financing into your cash flow. Before we jump straight into float, I'm just going to look at the moving parts that are involved in invoice financing. So when we look at invoice financing, sometimes referred to as an invoice advance or selective invoice financing, we're essentially releasing the cash that is tied up in our invoices. So when we use an invoice financing facility, we receive an advance for an invoice up front. Our customer then still pays us, and then we repay the advance that we received. So the rough float looks like this. And this is essentially the three moving parts that we need to consider in float. The upfront advance, putting the invoice onto the correct date when the client will repay, and then the advance repayment. The bit that we're not looking at here is the fees. When we factor in fees, we don't get another moving part, but rather some fees are paid on the initial advance, and then some fees are paid when we repay that advance. So again, when we're thinking about float, we're still only looking at three moving parts. Let's look at an example that we will forecast in float. So on screen here, I've got an example from our partner Triver where we are financing a £20,000 invoice. We're taking that across a period of 62 days. And really handily, we get the two figures that we need for float at the bottom. We get the funds that will be transferred today, which is 19,880, and then the repayment after the 62 days, which is 20,624. Now, both of those take into account the fees that will be paid. So again, we do not have to forecast those separately. So moving into float, let's look at how we would forecast this. In our cash flow here, there's two pieces that we will bring in from our accounting platform. The first is the invoice, which if I click in here, we can see we've got our invoice here. It's already dated on the 27th of January, so we don't need to make any changes there. That's the date that we are going to also repay the advance. When looking at this, it's useful to grab a piece of information that is specific to this invoice, and then we can factor that into the budget name so we know what everything relates to. In this case, I'm just going to use the invoice number here. The second piece is the account that we will forecast against. Now, in this cash flow example, I've got an account called Invoice Advances, which I added to my accounting platform and synced through. Now, you might not have an account called Invoice Advances, so you can either add an account into your accounting platform that you will specifically use for modeling your financed invoices, or you can use an existing account. The important thing to remember is that you forecast against the account where you will reconcile those payments from your invoice financing provider. That just ensures that everything is contained in the one place. Let's get down to forecasting this invoice finance. So I'm just going to pick a one-off budget, and I'm just going to use the invoice number that we grabbed from the invoice and that first figure, which was 19,880, and let's just say I get that today. So we can immediately see on the graph the impact that bringing that money forward has. Before, we would have dipped down below zero, but if we're able to finance this invoice, we can avoid that. So save that. Great, so that's the first part done. We've already got our advance in there. Now, we've already taken care of the invoice, so that's the second part done. The last part we need to factor in is the repayment. Now, a handy tip here is to add the advance repayment into the same budget where we have initially forecasted the receipt of the advance. There is a good reason for this. One, it keeps everything together that we will shortly see. So 27th, and now we just use the second figure from the calculator, which is 20624. Now, as this is an income account, we want to add a minus to reflect that it's cash leaving that. So yeah, as you can see, it keeps everything together. Our cash flow has now updated to reflect that we will be repaying this amount. The other benefit to having everything on that one row is now I'm in a position to quickly answer the question, if I didn't finance that invoice, here's what my cash flow looks like. If I do finance it, here's what it looks like. So based on that quick look, we can see that there is a definite advantage to financing the invoice because we avoid that cash gap. Now, I've just added one invoice here. However, if I wanted to look at the impact of financing additional invoices, what that does to my cash flow, I can simply add another budget in, and then I can easily toggle them on and off as I need to answer those questions. Just to recap what we've looked at today, when financing an invoice and modelling that in float, there's three moving parts. The first is the advance that we'll receive. The second is making sure the invoice is on the correct date for client repayment, and the third is then forecasting in the repayment of the the invoice advance. With those three moving parts included in the cash flow, we're ensuring that we've got all the information there to make the best decisions. If you have any questions, please contact us at support@floatab.com, or alternatively, you can use our in-app chat via this chat icon down in the bottom right. Thank you.